Hello, scholars. My name is Joseph Ejike Oji. Our topic of discussion today is on type of risk. And we also cover some concepts on beta, stock beta. Okay, stock beta. Okay. So we'll be looking at these two things. I hope you can see my screen. All right, let's make sure you can see it, and then we can begin. Yep, I think you can see it. So we'll be looking at types of risk and then stock beta. Remember that all these concepts we are covering comes under the broader topic of risk and return. So between topics on this, under this umbrella for the next several lectures until we finish everything we need to cover on risk and return. So then let's begin with type of risk in the market, and then we can take a look at stock beta. There are two major types of risk. Excuse me. Two major types of risk. One of them is the market risk. The other one is the diversifiable risk. Market risk is part of the stock, every stock. Let me put it this way. Market risk is this type of risk that cannot be eliminated by diversification. I remember that in my previous lecture, we covered diversification, how to diversify our portfolio to reduce risk. So that part of the stock that or your portfolio that you cannot, or that kind of type of risk that you cannot eliminate through the diversification is what we call market risk. So usually market risk are caused by things that systematically affect most firms. Things like war, inflation, recession, high interest rates, and so on and so forth. So when these kind of things happen, it affects the whole stock in the market. And because most stocks are affected by these factors, when they occur, we say that we cannot eliminate market risk through diversification. I'll give you some examples. Many projections were made about the price of oil. I'm talking about crude oil, the WTI and the Brent crude in 2019, 2018, 2019, 2000, but all those predictions went out of the roof when the world was struck by COVID-19. Oil price plummeted, fell significantly. Then more predictions were also made that it, some analysts were saying that it will continue to fall until we recover from the vagaries of the COVID-19. Then the war in Ukraine and Russian war began, and oil price jumped again. So those companies in the oil industry made a lot of money. Another example, if there's a recession, it affects the entire market. Go country, when we have the 2008-2009 recession caused by mortgage bubble burst, many stocks fell. Most of the stock in the market, I'm talking about 90% loss of value. So market risk cannot be diversified away, and it's caused by things like that. So now, the second type of risk is the one what we call diversifiable risk. These are the kind of risk that we can eliminate by diversification. because they are caused by random events that affect a particular company or industry. Things like lawsuits, strikes, marketing programs, winning or losing a major contract, and so on and so forth. So these events usually affect specific firms. So now, because they affect specific firms, if you have 5 companies in your portfolio, if one of them is affected, the profit or the bad event in that firm will be offset by the profit you are making from the other 4 firms or 4 companies. I'll give you an example. In 2015, we have what we call the Volkswagen emission scandal. So that the scandal is basically what is they were saying at that time was that Volkswagen was cheating in their emissions. So the scandal over Volkswagen cheating pollution emission tests is a good example of a random event that affected the company, Volkswagen. And this thing happened, I think, is around September 2015, when the U.S. Environmental Protection Agency found that many Volkswagen cars that were sold in U.S. had a defeat device or software. Now, this software, they put it in Volkswagen cars that use diesel. So they put them in diesel engines mainly. So this software can detect when they are being tested, when those cars are being tested for emission. And because they can detect when they are being tested, they now change their performance accordingly to improve their score on the emission tests. So the U.S. Environmental Protection Agency during that time issued a notice of violation of the Clean Air Act by the Volkswagen company. So during that time, this price of the Volkswagen stocks plummeted. Volkswagen lost a lot of value during that time. But those that invest, both the people that put their money, that invested in Volkswagen and in other companies, well, okay, your Volkswagen stock lost money or lost value, but you still have other 10 other stocks that are, that have value because you diversified. So the risk or the bad events that happen to Volkswagen will be offset by the good events in the other investments. So now you can see the difference between the two. Market risk affect the whole company, the whole industry, or the whole companies in a country. They cannot be diversified away. But diversifiable risk can be diversified away. Having said that, we can now move on to the next concept. Excuse me. But before we do that, there are a few things we need to know or elaborate on. Let me put it this way: diversifiable risk, we also call them unsystematic risk. Then we call market risk, systemic risk. Some people say systematic risk. So now we measure the market risk using what we call beta coefficients. So what is beta anyway? Now beta is the best way to explain it is that it is the risk observed in a security relative to the risk of the market portfolio. So based on this explanation, we say that the market risk is equal to 1. Okay, so that is what is generally the number we use to represent market risk is 1. There's a reason for that. I will explain in a few minutes. Now, if the market risk is 1, that means all stocks or assets with betas that are greater than 1 are riskier than assets with beta that are less than 1. So if the beta of a stock is greater than 1, it means that stock is more risky than the market. generally speaking, the stock beta will change over time, because it relates to the stock's performance, to the return of the raw market. So, and this is always a dynamic process. Okay. Now let's look at the types of beta. And after that, I will explain, at the end, I will explain why market risk is one. Okay. But let's look at the type of beta. Now there's beta that is equal to 1. Okay. Beta values less than 1. Then beta values that are greater than 1. Then we have negative beta. Then let's start with the beta value greater than 1. Remember, this is the number that we use to represent market beta, which is 1. If a stock has a beta that is 1, it means that its price is activity. Its price activity is strongly correlated with market. That means if market goes up, that stock goes up. If market goes down, stock goes down. So in the other words, so because it has a beta that correlates with the market, it means that that stock has suffers from, well, of course, I would say vulnerable to systematic risk. The market is down, it just goes down. Remember that there's some stocks that are not vulnerable to market risk. In a subsequent lecture, I will explain why. So we add this kind of stock that have beta of 1 to your portfolio. It does not add any risk to that portfolio, but it also does not increase the likelihood that the portfolio will provide big return. Okay, that's taken care of. So beta of 1 move in the same direction as the market. If you add it, this doesn't add any risk to your portfolio, but at the same time, it doesn't. The likelihood of your portfolio adding value is, limited. Let's look at some stocks that have beta less than 1. Now, when you say that the stock has a beta that is less than 1, I mean that the security is less volatile than the market. It's not as volatile as the market. So when you add this kind of stock to your portfolio, it makes it less risky. Make your overall portfolio to less risky. Good example of stock that can have this kind of beta. We have things like the utility stocks. Now, utility stocks include those companies that provide the basic services. Things like that everybody needs, basic service that everybody needs. Things like electricity, natural gas, sewage, and water to home and businesses. So whether the market is down or not, people still need energy. They need to light their house, people light in their houses. They need to warm their houses during the winter time, or to cool their houses during summertime. They also so the company that provide this kind of services, we say that they are defensive sector or defensive company, because they are relatively immune to economic cycles, because consumers always require their services. So stocks like, good example, like Next Era Energy Incorporated or Constellation Energy Corporation. These are stocks that might have low beta because they tend to move more slowly than the market. And when you add them to your portfolio, it doesn't add any risk. Instead, it made them to be less risky. Okay. Right. Making sure that you are still with me. Okay, good. Now, then we can now take a look at beta that is, or beta value that is less than 1, greater than 1. Now, a beta value that is greater than 1 indicates that the security price is theoretically more volatile than the market. So market move is if its market is going crazy, that security or that stock go even crazier. So it's more risky than the market. When you add that stock to your portfolio, it will increase the risk of that portfolio. You make your portfolio to be risky, but it can also make their portfolio to bring it bigger returns. Example, if a stock beta is 1.2, the one I use here, for instance, that means that that stock is 20% more volatile in the market. Now, stocks like that, good example of stock that can have this kind of beta are usually technology stocks. Yeah, things like Apple and Cisco system can have this kind of beta. Because technology stock is bringing a huge, big value. I mean, especially if a company, through their project, invented a technology or invent a technology that is, very popular. That means it will add more value. If you see that stock jump, when Amazon started some years ago, nobody knew that their value would increase so much. People were saying, why would I want to buy it? Because Amazon started as a book seller, online book seller. People were saying, why will I buy, if I want to buy a book, why do I have to go to a computer and have the trouble looking for the book? Why not just go to the bookstore? Well, Amazon now, if as time goes on, today Amazon is one of the biggest, in fact, it's the biggest bookseller in the world. Many of those booksellers of those days, like Borders, and even Barnes and Noble, Borders have closed, I believe. I think it closed down because of competition from Amazon. Not only that, other retailers are having big competition from Amazon. So Amazon value, skyrocketed. And of course, that Amazon is a tech company now. But then recently they did what they call a stock split. As I'm talking to you, I think about around 2021, Amazon stock was almost like $2,000 per share. But today, let me show you what it after they did a stock split. So you can see the kind of volatility we have in tech company. Amazon AMZ, and I believe, yep. And see what it is now. This is $84 per share. This is a stock that was 2 years ago was almost was about $2,000 per share. Look at now, $84 per share. That will tell you how volatile tech stocks can be, and that's why they usually have a beta of that is greater than 1. Yeah. Now, make sure I have this. Yep, I got this. Now, another example, Cisco systems, Cisco, and other small cap stocks. Now, negative beta value. Some stocks have negative betas, and when a stock have a beta of -1, for example, it means that the stock is inversely correlated to the market benchmark. When I say market benchmark, I mean things like S&P 500, Russell 3000, those benchmark, those things that we use as standard against which the performance of a security or investment strategy or investment manager can be measured. We use our standard for measuring, assessing, the performance of stocks or portfolio. Now, a beta of -1 means that the stock move inversely. So if the market is up, it is down. If the market is down, it's up. So in other words, the stock tend to increase the price when the general market falls, and vice versa. So good example of assets or investment that can have this kind of beta, like things like put options. We haven't done options, how to trade in options in this class. So we're eventually going to deal with them. Then there's a study called exchange traded funds. When I discussed the types of mutual fund, I think I discussed this exchange traded fund. Like I said, I'll give you an example. Suppose you want to invest in gold. Now you don't have enough capital to buy physical gold, but you can invest in stocks or assets that track gold. A mutual fund that track gold or invest in gold. We call it gold exchange traded funds. That is what exchange traded funds are about. You want to invest in an asset. You don't have the money to buy the physical asset, but you can buy mutual fund that trade on those assets. And then when you buy them, you become an investor in that asset. So that kind of fund, we call them the exchange traded funds. So, and they are designed to have negative betas, just like the good options. Another example, a few industries like gold miners, we have negative betas. Now let's take a quick look at this, what I have seen so far. Now, the market has 1.0. That is beta for the market 1.0. Why? Because the only short thing in investing is that we cannot eliminate market risk, no matter how much you try to diversify. So that's why the market has a beta of 1. It is sure that it can't eliminate it. Now, to beta of 1 means that every 1% change in the market, individual security or investment will likely move 1%. So, but even the beta is greater than 1, that means the asset has more risky, or it's riskier than the market. So you have more amplified movement than the market. Now, I'll give an example here with the beta of 1.4, which means that our market, the investment return will be likely to be 1.4 times as volatile as the market. That means more volatile than the market. Now, if a beta of less than 1 means that security move is not as volatile as the market. Even though it moves in the same direction with the market, but it moves slower, not as fast as the market. So I give an example here with a security that has a beta of 0.85. That means it's about 15% less volatile than the market. Okay. Now, beta have so many limitations. Remember that the beta coefficient, the theory behind it is the assumption that the stock return are normally distributed from a statistical perspective. But the truth is that financial markets are very prone to surprises. Returns may not always be normally distributed. So what does that tell us? That the stock beta might predict what it might predict about a stock. It may not always come out to be true. Of course, it gives us a measure that is close to what the market will have to do, but not always the case, because the returns are not always normally distributed. Another one is this. Beta is very useful when we want to determine the security's short-term risk. That means at a short term, using beta to estimate the risk of a security is useful, but in the long term, it doesn't. Also, when we use beta to analyze the volatility, to arrive at cost of equity, when using a model that we call capital asset pricing model, then beta can be useful. But remember that beta is calculated based on historical data points. So this means that the results may not be meaningful for investors that are looking to predict stocks' future movement. Now, there's more limitations. I'll mention two or three more. The other one is that beta is less useful long-term investment. I think I mentioned that already, because the stock volatility can change significantly from year to year. So depending on the factors that affect the company or the stage that they are in production. Now, the beta of a stock can also jump around over time. So again, it is not reliable. It is unreliable as a stable measure. Now, many finance experts believe that beta is good. It provides information about the risk of a stock or a portfolio. You can also use it to measure risk, but it is not necessarily an effective measure of risk on its own. So it makes estimating beta. We want to estimate beta. We make use of the stock's past performance relative to a benchmark index like a S&P 500. So what does this mean? It doesn't tell us what the risk could be in the future. So it does not provide any forward guidance. It does not consider the fundamentals of the company or its earning or growth potential. So because of this, it is always recommended that, okay, if you want to use beta as a measure of the stock risk and for valuing the company from a rapid perspective, it is important to also, when you finish that kind of analysis, also look at other areas about the stock. I would say use another evaluation measure like fundamental analysis using a ratio analysis and other means of evaluating risk. So don't depend only on beta. Try use other, at least an extra evaluation measure would be good. So the question now becomes, what would be the ideal beta? Well, it depends on the investor's risk tolerance level and the investor's goal. So it depends on how or the ability of the investor to tolerate risk, which is called the risk tolerance level, and also their goal. Now, if an investor wishes to replicate the market in their portfolio, then they can use a beta of 1.0. That would be okay for them. But if the investor is a conservative investor who is more of thinking about the future and to preserve their capital, then a lower beta of say 0.85 or 0.90 should be good enough. Now, if you are riskier, you want to take more risk, and you might use then the ideal beta for you might be a beta that is greater than 1.0, which it can produce above average returns, but can also lead to big losses in the bull market. I hope you enjoy my lecture today. Next lecture, we'll be looking at the capital asset pricing model. That'll be our next topic. The capital asset pricing model that we use to price risky asset. Thank you for listening, and I will see you in my next lecture. Good night.